You have probably seen the headlines over the last week or two. Are good credit borrowers going to be subsidizing those with lower credit? Are your payments going to go up because you have a higher credit score? And in today's video, I'm going to get down to the bottom line here and figure out what these new rules from Fannie Mae and Freddie Mac are all about. Hey everybody, Brandon Boyd with The Brandon Boyd Show. Thank you so much for watching. If you find this video helpful or mildly entertaining, don't forget to be awesome. Give me a big thumbs up on the video and subscribe to the channel. Hit the bell notifications for alerts. Also, keep in mind if you're interested in applying for a new credit card, make sure you apply using my referral link down in the description below. That does greatly help support the channel. This video is going to be a little bit different than what I normally post. So as many of you know, I am a realtor. I've had my real estate license for several years now. There are some new rules from Fannie Mae and Freddie Mac that appear to show that good credit borrowers are going to be subsidizing those with lower credit scores. I'm tired of reading the headlines. I'm tired of hearing the political talking heads on TV try to answer this question for me because they all have skin in the game. So in today's episode, to bring some more validity to this topic and find out if it's accurate, I'm going to bring in a special guest. We're going to have a conversation about this rule. It'll last about 8 minutes, 10 minutes or so. And then after that, I will give my final analysis on this and give you my real thoughts on it at the end of the video. But I'm going to bring in the Regional Vice President for Stockton Mortgage, Brian May. And you can check out their website, stockton.com, if you want to inquire about a mortgage. You can certainly do that. They are licensed in 25 states and headquartered here in Kentucky. So I'm very familiar with their office, to say the least. The reason that I'm bringing Brian on the show to talk about this is because he has no political persuasion as far as this goes. He's just going to give us the nuts and bolts of what's really in these changes that started on May the 1st. He's going to let us know if these rumors or rules are accurate from what we've been hearing on TV and online, because we all know everything on TV and online is accurate, right? No. And make sure you stay tuned to the end, because at the end, he reveals what credit score you need to get the best interest rate now. And here's a hint. That score just went up, all right? So you're gonna have a higher score to get the best interest rate. Yikes. That and a lot more. Let's get into the conversation. All right, Brian, great to have you on the show. This is a really hot topic. I've seen headline after headline. I've seen, audio clips, TV clips, all talking about how, the people that have higher credit scores are essentially subsidizing those with lower credit scores. And, as a real estate agent myself, or a realtor, I've got a pretty good idea of what this whole thing means, but I really want to get down to the meat and potatoes of this. Is that true?
Well, the short answer is yes, it is.
It is. Okay. So that answers the question. We can just cut the video off right there.
That's right.
There's probably a lot of details behind this. And the reason I wanted to bring you in here is because even though it can sound like a simplistic issue, people with good credit scores are paying for people with bad credit scores. There's got to be more to it than that. And I really wanted to dive into that. So what do you mean when you say, yeah, it's essentially true?
Okay. Well, it really all has to do with something called loan level pricing adjustments on conventional loans. So when you get a loan, everybody starts kind of with the same basic interest rates. And then adjustments are made to the rate based on your risk, right? So your risk is determined primarily by how much money you put down on the house and your credit score. So the less money you put down and the lower your credit score, the more risk there is for the lender and the higher your rate. Now, there's other things that affect the rate, like if you're buying an investment property or second home, or maybe buying a duplex as well.
Right. So, I mean, and that seems like, okay, everybody gets that. If you put down, less money, you're higher risk, your rate is going to be higher. Mm-hmm. Right.
Correct.
I mean, that's right. Always worked. That's okay. So when we're talking about loan level pricing adjustments, in particular with this topic, I mean, it's not anything new. I mean, when did all this start? What does that mean? What does it mean in layman's terms? You got some bourbon behind you. Let's say I've just had a glass of bourbon and I'm saying, hey, Brian, explain this to me like I've had one glass of bourbon.
Sure.
Can you break that down for me?
So loan level pricing adjustments, they've been around for a long time, but there were some big changes that have been announced that are happening May 1st. And really they've started before May 1st, because it's May 1st is the date where Fannie Mae actually buys your loan. So everybody's kind of put these into effect already. But the loan level pricing adjustments for borrower who puts less money down and have a lower credit score are being lowered, and so that they have now a little bit lower rate. Now, we kind of all know there's no free lunch. Somebody has to pay for this, right? So the adjustments for borrowers with higher credit scores who put more money down, those adjustments are being raised, so their credit scores are going up.
So essentially, you're still going to get a better rate overall. when you have a better credit score. So you're still in better shape, because I've heard the argument of people saying, well, why in the world am I working so hard to get this credit score if we're all just going to be evened out anyway? Why am I working this hard to do this? And I know the people in my audience work hard to pay their cards off every month, to make their payments every month, to build that credit score. So you're saying that in the end, you're still going to get a better rate. It's just the gap after the adjustments is bringing it a little closer together, but you're still better off.
That's exactly right. So if you have a high credit score, you're putting money down, your rate used to be here, and somebody with a lower credit score and putting less money down, their rate was up here. Well, their rate's going down, this rate's going up, so that gap is just lower. But the people that have a higher credit score are still getting a better rate.
So why even introduce this? I mean, it does sound in a way that you are punishing people that are doing a good job, that are paying their bills and building their credit. I know that you're still better off, but it still feels like, hey, I'm working really hard, and they're just turning the screw to you a little bit. Am I reading that wrong? Why are they doing this?
So it all goes back to an agency called the Federal Finance Housing Agency. And they're a government agency that controls the loan level pricing adjustments. They also oversee Fannie and Freddie. They have a goal of making home ownership more affordable for people that may have lower credit scores and a little less money to put down. So that's
they're actually trying to give the American dream to more people.
Trying to get more people
to be sold.
Right. But the problem is somebody's got to pay for that. And the people
it's not free.
Pay for it, it's not free.
Are you going to sit here and tell me that a government program is not free? I'm not buying it.
Surprisingly, it's not free. Somebody has to pay for it. So they've chosen the people with the higher credit scores and people putting more money down. That's who's offsetting the cost of the people with lower credit scores.
Well, let's talk about credit scores, okay? So when we're talking about specific numbers, all right, if somebody's trying to look and say, okay, I wonder if my credit score is going to be one of the credit scores that's going to be impacted by this, how will they know if they're going to be impacted in a good or a bad way? Is there a certain cutoff? I've read all kinds of different numbers, but is there a certain cutoff where somebody is going to get the benefit on one side, and then on the other end, somebody else is going to get a higher rate?
Sure. In general, the people that are getting the benefit are people that have a credit score of 680 or below and maybe less than 5% down. Those people are getting a much better rate than they were before. Now, if you have a credit score above 680, you're putting 5% or more down, you may actually see your interest rate go up. So, and the other thing they've done is it used to be if you had a 740 credit score or above, you got the best interest rate. Well, now to get the best interest rate, you actually have to have a 780 credit score or above.
Nice. Okay, so they're making it even tougher to do that. It's very interesting. And it's really interesting to do this in this particular environment, because I'm sure everybody's aware, interest rates have gone up pretty significantly when you compare them even to this time last year. I mean, the jump has been pretty high, and then to even possibly, have a higher payment now because of these, new implementations on May 1st, it's kind of scary for a lot of people with a housing market that's kind of like, I don't know if I want to get in it or not with the rates. I mean, are you seeing that yourself with applications? I just want to know, honestly.
Oh, yeah, absolutely. I think, one of the reasons they're doing this is because we do have an affordability crisis in this country. And so they're trying to make home ownership more affordable for that one group. But everybody's feeling it, right? Interest rates are up, inventory's down, so prices are up. So everybody's feeling it. I've had people that, they were looking at a house, let's say they're looking at a house a year ago, and just couldn't find anything because, when you went to offer on a house, you had to pay 10, 20, 30,000 more than the list price to get it, right? And you're competing.
And that's in Kentucky, by the way. We're in Lexington, Kentucky. So when we're talking about that much over asking price, just to give people nationwide kind of an idea, when you're talking about a $250,000 home and you have to pay $30,000 more, that's a lot.
Exactly. So they were looking maybe a year ago, and a year ago maybe rates were 4.5%. They were just off their low point. Well, now they're looking and rates might be 6.5%. So that's a big jump in payment. And even though things have slowed down a little bit, prices haven't gone down. They still are going up. So that house that they were looking at last year that might have been $250 might be $280 this year.
Yeah, it's that balancing act. The prices are still going up here in Lexington, at least. I know it's different in different pockets of the country. So the price is going up, and you have to balance that with getting an interest rate. It's like, okay, do I lock it in now before the price is even more expensive on this home next year? Tough position to be in for sure. Now, just for, I think, the general audience purposes,
we've talked about Fannie Mae and Freddie Mac. Who are they? Can you explain it so everyone can understand here? Because I think we all hear that on the news and we're like, okay, Fannie and Freddie, but
Right.
who are they really?
Well, it's important to realize these changes we're talking about are only for conventional loans.
Mhm.
So those are controlled by Fannie and Freddie. It doesn't affect FHA loans, VA loans, rural housing loans. So Fannie and Freddie, they're government agencies, and their main role is they buy mortgages from mortgage companies and banks, and then they replenish the money back to the banks and to the mortgage companies so they can make a little more loans. So really, they provide the liquidity in the housing system. So that's their function. But in doing that, they also get to now make all the rules, because in order to sell that loan to Fannie or Freddie, you have to follow Fannie and Freddie guidelines.
Yeah. So somebody's got to set the rules around here, Brian, or everything just goes haywire. It goes haywire. Well, I don't want to dive too deep into this, but I do want to wrap up with one more question, I guess. Is there anything else beyond what we talked about that people need to know, besides the headline that good scores are paying for bad scores? Is there anything else that you would say, maybe look out for this nugget or two, or anything else in the
There
changes?
is kind of one poison pill that was in these changes that a lot of people don't know about.
I don't like the sound of that, first of all.
You don't.
Can you call it
So
something different?
they've introduced a new risk adjustment for people who have a debt to income ratio above 40%. Fortunately, that nugget was delayed until August 1st, and there's a hope that they may do away with that entirely. But if that happens, then doesn't matter what your credit score is. If your debt to income ratio goes over 40%, then your rate's going to be higher still.
Wow. Okay. So what if you're over 40% and you have a good credit score? You're going to see just a huge difference in your rate. Is that accurate? I'm just asking.
Yeah, I mean, now, when you say huge difference, it's not going to be a point, but it may be a quarter point, 3/8 of a point, which can make a big difference in your monthly payment.
Oh, that's good to know. Putting it into perspective is a big deal. But I know when you're trying to look at that home, people usually try to push up to the max of their budget, and every little like $40 or $50 you add on to the monthly payment, it just digs away at you. It's like the death by 1,000 paper cuts. It's like every little $10. It's like, ugh.
Yeah, you've got your interest rate, and you've got your payment, and all of a sudden during the process, your loan officer calls you and said, "Hey, and your homeowner's insurance was a little bit more expensive than we projected. You're now over 40%, and now your rate's going to go up." Well, that could certainly happen if they put these changes into effect.
Yeah. Well, I guess at the end of the day, if you have a good credit score, you should still come out better than if you have a lower credit score. In this case, a 680 or lower, you're still going to get a better rate if you have higher than that. Is that a good way to frame it all up? It's just the gap is not going to be as wide as it once was.
The higher your credit score and the more money you put down, you're still going to get the better rate.
Well, that's good. Let's end it right there, because I think, at the end of the day, I just wanted to cut through all the stuff that's on TV and all the headlines and put it into perspective. So everybody still pay your cards off, pay your payments, increase your credit score. At the end of the day, it is going to pay off. Whether it's a mortgage or anything else, it will help you out. And, we talk a lot about credit cards on this channel too. Some of the more premium credit cards will require a higher credit score. So there are a lot of advantages to continuing to do that. So Brian, I really appreciate you jumping on. Thanks so much. And if it's all right, we may have you on in the future to dig into some more housing and mortgage talk, because you do a good job with it. Maybe next time we'll pour a glass of bourbon and talk about it.
Sounds great. Thanks. Appreciate it.
All right. Thanks.
All right, I want to thank Brian for joining me in that conversation. I know it's a lot of nuts and bolts and how things work, but it's really important to get down to what is actually happening out there without the political spin one way or another. In my opinion, in general, I'm not a fan of punishing those people that have higher credit in order to subsidize lower credit. It just doesn't make sense to punish those that are trying to do their best to make their payments and do what they're supposed to do. I just inherently find something wrong with that, but that's my 2 cents. If you disagree with that, leave that down in the comments below, because hey, we're an open book here. I don't care what your thoughts are. I just want to know what you think, because it will help others in the community that may have similar opinions as you. And just because you disagree with me, who cares? I'm just one person, and there are millions of other perspectives out there. I really want to hear what you think about this, so leave that down below. Keep in mind, if you are interested in picking up a new credit card, use my referral link down in the description below. That does greatly help support the channel, and I can't thank you all enough for doing that so far. If you found this video helpful or mildly entertaining, don't forget to be awesome. Give me a big thumbs up on the video. Subscribe to the channel, hit the bell notifications for alerts, and when you click on the Brandon Boyd Show, click You're going to get the latest information on credit cards, points and miles, travel, money, finance, and everything in between. And I look forward to seeing you on the next episode. We'll see you soon.